Hi, everybody, and welcome to our Pre-SC20 market update for high-performance computing. My name is Addison Snell. I'm with Intersect360 Research, and I'm really glad that you're joining me today. I've got a mostly new presentation for everybody today. I am going to revisit a couple of topics that we have presented earlier in the year, but mostly to touch base on them and see how a lot of our trends or predictions are holding up as we head into SC20. I will say up front that I will take question and answer at the end of the presentation. We're not going to interrupt the presentation as we go along. If you have questions that you'd like me to address, you can put them into the chat function in the Zoom format, and we'll monitor those and get to them at the end of the session. Some of what we'll talk about today, I really want to touch on the full effect of cloud computing across HPC rolled up from multiple budget segments. And you'll see what I'm talking about here. Cloud computing is something we've been monitoring for 10 years in the high performance computing market. And we have it as a segment in the market. But as we dug deeper into some of the market segments from our existing market forecasts, it became clear that the full effect of cloud computing, some of it's hiding in other market segments, so we're going to talk about that. I'm going to have a brief discussion of return on investment of high performance computing related to an editorial we published recently with HPC Wire, using some data we already had. It's not really a comprehensive ROI study, but it's important to look at the conclusions of that before we look at a check-in on our forecast for 2020 in particular, but also 2021 out through 2024 as it relates to the COVID-19 pandemic, which of course is still a very present topic for us worldwide and does have a significant effect on our market. So we'll do a check-in on that. And then, of course, important trends that we're going to be watching as we head into SC20, continued impact of AI on HPC budgets and HPC deployments. We'll look at what data we have on that from our research, consolidation in the processor market, both from an acquisition standpoint and from a technology roadmap standpoint, both of which are going to have an impact in HPC. I do want to make a quick touch on what's going on with data tiering as it relates to NVMe and flash, particularly with regard to on-node storage and persistent memory. And as part of all of that, particularly as it relates to processors, we'll go through some of the data from our HPC user rating study that we did this year. Not a full presentation of that because that's still with our clients of that study, but for the processors in particular, we'll let go of some of that discussion or some of that data as it will fuel the discussion of the processor market in particular. So once again, if you have any questions, feel free to post those in the chat function. I'll get to those at the end of the presentation, and let's dive in. Okay, so first we're going to look at the worldwide HPC market in 2019, not 2020. 2020 is still an active year or a forecast year. We're not going to wrap that up until spring at the soonest, but I want to revisit some of these numbers in particular as it relates to cloud computing in this market. So I'll do a touch base on some of the numbers we presented before. I'll add detail that we have not presented publicly previously, although we have presented it to our clients, and we'll talk about what it means for cloud computing in HPC. This is the overall notes for 2019. Just to do a level set, the worldwide high performance computing market, $39 billion in 2019. That was up 8.2% from 36.1 billion in 2018. That was a point higher than we had forecast at about 7.1%. Interesting note was that the government sector took over the highest growth sector after industry had led for 6 years, and we do expect government to continue to lead in growth over the 5-year forecast. But here's what I want to dig into a little bit more. The servers and the storage, which are two of the largest segments, servers is largest and the storage is third largest after software. What you think of is the major on-premise hardware portions of HPC deployments were really lower than that. They were in the mid twos, between 2 and 3%. We'll show some of that. So how do you get growth that's up at the 8.2 range when the on-premise major deployments were around 2.5? Well, there was huge growth in not only cloud, but also what we've been calling cloud-like deployments. And those are things related to cloud, but users did not report to us as being directly in the cloud segment. Other major trend was the top vendors declined in market share relative to the others without really major changes in rank. And we saw the next tier below the top vendors all gaining in share as a result. I will quickly revisit market shares. This is looking at the server portion of the market, the compute portion. HPE and Dell still in a near dead heat for number one. HPE with a very slight lead. Those two vendors combined for about 60% of the market, and then there's a big drop off down to everybody else. The HPE revenue here includes Cray revenue after the acquisition, which completed in September of, that should say, 2019. That completed in September, so HPE really only had about 4 months worth of Cray revenue. Cray revenue from prior to the acquisition, in this case, was moved into the others column so as not to be misleading by calling out a separate Cray number. HPE this year in 2020 will have the benefit of a full year of revenue contributed from the Cray division, and that might help consolidate more of a number one server position. Lenovo on this is the largest vendor that showed year-over-year growth. IBM had grown in 2018, but fell back again in 2019. And then everybody else below that were all posting growth. Interestingly, including Huawei, showed healthy growth despite the fact that they have an ongoing trade and political conflict with the U.S., which just goes to show how little Huawei depends on the U.S. as a core market. They could, they're not going to do any worse in the U.S. than they were already, and they still posted healthy growth, although the double-digit growers here were Atos, Penguin, Inspur, Fujitsu. Atos was the biggest overall. Others, there's a wide range of others in here, including NEC, NVIDIA, Sugon, Supermicro. Supermicro, probably the largest one that we don't call out separately, probably bigger than some of the other vendors that we already do call out here. But a lot of their revenue goes through reseller engagements, and therefore it gets more difficult to track. And a lot of it doesn't then go onto the Supermicro line. It would go onto the line of the reseller. So Supermicro's true share is bigger because they also capture from a lot of the resellers. We try to assign the revenue to the end seller in this case, so it's not to double count. NVIDIA is bolded because they're interesting here as a server vendor. This is with their SuperPod sorts of deployments. They're now competing as a server vendor. Not so much that we're calling them out separately on this chart for market share right now, but certainly a dynamic we continue to watch. Storage, we also break down by segment. Here's where Dell EMC has a clear lead, mostly due to the wide breadth of products that Dell EMC offers. NetApp had a really poor year and fell behind HPE, despite the fact that HPE also fell. NetApp fell more, which brought them down below HPE. IBM also declined. All of everything else below IBM was all growing. Lenovo, again, the largest vendor that grew. DDN is really the one that had the huge growth. Atos and DDN posting double-digit growth. But here, Atos, a lot of their growth is resale of DDN product that's showing up on the Atos line. So DDN's growth is underrepresented, but when you look at just the DDN segment, or the DDN pie slice in this case, DDN had growth that also showed up on other vendors' lines when they're reselling DDN product. Here, there's a really big long list of others. And I'm not even going to read them all off here, but Intel is bolded because they are interesting now as a storage vendor because of Optane persistent memory. And I'm going to be talking about NVMe and Flash on node, and Optane is a big part of that later in this talk. We're not calling that out as a market share specifically on this slide, but it is, again, a trend that we're watching. Okay, now getting into some of the trends that I promised we would look into. This is a chart we showed graphically before about how the market breaks down. And you can see the cloud segment there, second from the top, which is visible in terms of having the biggest growth in the market, but maybe not as big as some other people might have thought. And what we haven't shown before publicly, although our clients certainly have seen it, is some of the numbers behind that. This is how the product and services segmentation broke down 2018 into 2019. I've got an arrow highlighting the growth of cloud, bringing it to 3.7% of the market in 2019, with 17.8% growth, or $200 million in growth from 2018 to 2019. That's double-digit growth. Now, you can see that we've got it at $1.4 billion. The big question then is, does that reflect the complete role of cloud? And you saw in the highlight slide at the top that we also saw big growth in what we call cloud-like deployments. So is that 1.4 billion the complete role of cloud? The answer there is no. And this is something we've been taking our clients through over the course of this year, although we haven't talked about it publicly. The key to that is in looking at some of these other numbers that are very high above market growth. Look at services with 26.7% growth, software with 8.2% growth, the other category, that notorious other category that's a catch-all, showing very high growth with nearly 30% growth. What's going on there? And when we double click down onto that with the data that we get from end users in the market who describe when they have gains in the other category, what we found was they're showing up in services other, software other. And this is other doesn't really have an other category. I'm just making the point that it's other. And a closer look into that when we read the comments shows the effect of cloud computing. Now, when we look at the server classes, we're already saying that the highest growth is up at the supercomputing segment of the market, then high end, then mid-range, then down at the entry levels where the lowest growth is. If we made all the growth rates the same and said, what if entry level, mid-range, high end all had the same growth rate as the supercomputer segment, there would have been $200 million more spending. Where is it? Well, that's the measurable direct effect of cloud computing. That's that $200 million of growth in cloud. And cloud is drawing more heavily away from the entry level and mid-range of the market than it is from the high end and supercomputing segment of the market. So there's at least $200 million right off the top in growth. That's the visible portion, that 200 million that we already talked about. So we've got that there. But then when we look at the cloud categories, the big growth was in the lower value add categories, the raw cycles, the storage. The higher value add categories, what we call environment hosting, which batches together infrastructure as a service, platform as a service, the IaaS and PaaS, software as a service, which we're calling your application hosting. Those were not showing big growth. Where are those value add portions? And again, that goes back to the growth that we're seeing in some of these other categories. This is what happened in the software category from 2018 to 2019. Not showing the detailed numbers here. Again, our clients have those. But look at what happened to the software other category. It went from essentially almost nothing to 3.5%. Now, when that happens, as analysts, what we usually try to do is double click on that other category, find out what people are doing, and see, can we reassign it to some category we already have? Where does it belong? And we've been doing that for a long time. All right, well, what they're describing really does fit into middleware. If they didn't call it middleware, it really fits into storage, even though they didn't think of it as storage, it really fits into system software. You follow my meaning. Or maybe it doesn't belong in software at all. In this case, we couldn't do that because what we were really finding is a preponderance of things that were like SaaS contracts that were showing up on the software line. Imagine you have a relationship with a third-party software vendor who's now offering utility pricing through a partnership with a cloud provider. You pay for utility licenses through the software provider, who then passes it through to a cloud provider. As the end user, I'm keeping that on my software line, but I find that when I report my budget in an Intersect360 Research survey, now it's not showing up well, depending on where else we had it. And that's measurable growth. That's 300 plus million growth in that software other category, that's primarily due to these SaaS and SaaS-like kinds of contracts. Let's look at services. Same thing. Services 2018 to 2019, that other category goes from under 3% of the market, which we normally like. We don't like having a big other category, right? When we get a big other category, it means we need to create a new category if there's something else going on there. And that happened again here. It went up from less than 3% to more than 8% of the market. That's over $200 million in growth in that services other category. In this case, what we're looking at predominantly is things that are very like managed services contracts, or even cloud services contracts. If I'm contracting through a company like, say, R Systems or Rescale or Nimbix, and I'm thinking of it as cloud services or HPC managed services, but it's getting fulfilled through a cloud. At some point, a cloud vendor gets a lot of that revenue, but the services are showing up on the services line with the cloud portion hidden. So all of that is part of the effect. And then go back to, I don't even have a breakdown of the other category, the top level other category, into what kind of other is it. But same thing, managed services, facilities outsourcing, other types of utility computing contracts that are all going into those other lines. When we try to roll up what's cloud-related growth, directly measured cloud HPC cloud spending, we had at $1.43 billion. You saw that on the cloud line before. But now if I add into that SaaS-like contracts that are in the software budget, another $200 to $400 million. I showed 200 million on the previous slide. Some of that's ambiguous because you don't know how much of that legit goes to the software licenses. But on the other hand, what you're looking at is a growing multi-year trend, which means there's likely some revenue in previous years that wasn't big enough to really move the needle on the analysis. But there's revenue from previous years also we can grab. So call it a range of $200 to $400 million. Cloud managed services showing up in services budgets, another $200 to $400 million. Other cloud contracts in other budgets, $400 to $600 million, depending on how things get allocated. We're giving ranges here to reflect that there's some ambiguity, that this isn't measured directly, but that gives us a range now of $2.2 to $2.8 billion, call it about 2.5, or roughly $1 billion more than we were previously reporting. Additionally to that, not counted here, we could look at AI, cloud native AI that is not affiliated with end users' HPC budgets. There do exist now a measurable portion of enterprise organizations who are not doing HPC, who are doing AI, and those tend to be cloud native. We've been tracking that in the hyperscale portion of our methodology because it is cloud native and only really exists in cloud. But to a cloud vendor like AWS or Azure or GCP or others, that's going to look like HPC spending. So if I'm going to provide advice to one of those companies on how much of their infrastructure we think is related to high performance computing, then I'm going to round up again. And depending on what they want to count, and this will be guidance to our client, do you want only training? Do you want also inference? Do you want only things that are GPU enabled? What things do you want to count? But it's easy to make a case for $1 billion plus or minus that could be added if you want to get into those AI workloads that are native to cloud, that don't reflect other people's HPC budgets, so they're not part of the HPC model, then I could get up to well over 3 billion, maybe 3.5 billion, depending on what you want to count. So I don't want to be wishy-washy as an analyst, but there's a lot of fuzziness here, and we don't like to double count things. What I will say is that for HPC in the cloud, what we can classically count as HPC in the cloud, directly reported in the cloud segment for 2019, $1.4 billion. Counting other cloud-like deployments that we can directly measure from the data that we already have, really your range is 2.2 to 2.8, call it $2.5 billion. If you wanted to count other non-HPC cloud native machine learning, it'll be higher still. That's generally not what we're talking about in an HPC oriented crowd, but some people like it. So we have the ability to model that in. This continues to be a high growth area in our 5-year forecast, particularly as we continue to look at some of the effects of COVID-19. And I'm going to come back to that as we revisit our forecast in a later portion of the webinar. Now, I need to stress a few things here methodologically. You see here we have methodology notes. We always try to describe this very carefully in our reporting about what we're counting. We are not adding $1 billion to the market model. There's another analyst that has done this that said, hey, we're not really counting everything in cloud. We're going to just add $1 billion onto the model. We're not doing that here. Our totals have all remained the same. What we're doing is providing publicly more analysis of how we can account for revenue in other segments according to what end users have told us in describing how that money gets spent. This money is already accounted for in these other segments, and it is accounted for with our existing methodology. Now, what it shows us is our budget surveys for next year really do need to be updated to account for these cloud types more specifically. When we get into SaaS or when we get into software accounting, we want to start looking for, do you have a SaaS contract that's accounted for in your software budget? Or do you have a managed services contract or a cloud services contract that's accounted for in your services budget? These are more direct questions that we can start surveying for. And as analysts, this is kind of how this happens. Some new trend happens, it shows up in other, double click on it, see what it is, and then start adjusting the methodology going forward. But for now, this is the guidance we've been giving to our clients over the course of this year about the trends in cloud computing. We've got it, we see it in our forecast, and we'll continue to adjust our methodology going forward. Our existing methodology has caught it, and this is the full effect of cloud and HPC. All right, that's the end of what I'm going to talk about here. I'm now going to transition to a relatively brief discussion about the ROI of HPC, and this is important for two reasons. One is we published an editorial on this responding to a multi-year study that our friends at Hyperion Research, our closest cohort in high performance computing, have done for a couple of years running, and I'll comment on that in just a moment. And I'm highlighting it here, this is the second reason, because it's particularly relevant to how we're talking about our forecast as it responds to the COVID-19 pandemic. And we really need to have this discussion to set up that discussion. So I'm going to spend a few slides on it here. Now, talking about Hyperion Research, normally we do not like to respond to any other analyst numbers. Hyperion has its methodology, we have ours. I don't attend any of their talks. I don't go to their HPC user forum. They can report what they're going to do, and we'll report what we're going to do. And generally, our numbers have nothing to do with their numbers. We each have different ways of coming up with it. Also, I like the people at Hyperion Research. I've worked with them before. I really respect Earl Joseph. I really respect Steve Conway. This ROI study that they have done for multiple years together with NNSA, Department of Energy, and other government funding is just awful. I don't respect that study at all. They've been putting out a study for multiple years that not only says directly that there's a 4,300% directly measurable ROI for buying high performance computing infrastructure, which is an idea that's patently ludicrous. And anybody who spends more than 10 seconds thinking about it knows that it's ludicrous. And so we have to put out some kind of response here, because we feel that it's misleading as analysts to even support that kind of notion. So we can have two questions. One is HPC worth it? Generally, yes. Companies buy HPC because they find it's worth it to buy HPC, and it powers a lot of innovation and science and engineering going forward. This is a very worthwhile endeavor. Does HPC in of itself generate $44 in profit, $460 in revenue for every dollar spent? No, that's nuts, and no one should think that it does. And I'm only saying this because Hyperion's been saying for years that it does, not just suggesting it, but saying outright, which is beyond misleading. It's just false. So here's the problem is ROI has a defined formula. And I guess this is what upsets me about the Hyperion study is just that they use the term ROI. This is how you calculate ROI. Net profit divided by total investment equals ROI. And that's not what Hyperion is measuring. That's not even what they say they're measuring. But then they use the term ROI. What Hyperion is essentially measuring, if you look at their research, is they're going to HPC users and saying, great, you've got this HPC investment. How much of your revenue or how much of your profits benefits from that HPC investment? Well, if you're an oil company, as an example, it's roughly all of it. You're not going to get to any of that oil if you don't do high performance computing. And so you can look at it and say, well, I used high performance computing. I drilled for oil. I got $200 million. So that's the $200 million in revenue that's directly attributable to high performance computing. And they count all of the revenue and all of the profits. Well, presumably you didn't use only high performance computing. You probably also used, I don't know, a drilling platform, ships, tankers. There's a lot that goes into it. So when you look at that total investment, that's what's not being counted, and that's what enables this inflated notion of ROI. Hyperion isn't measuring ROI at all. What Hyperion is measuring is how much of the revenue in the world is reliant at some level depending on HPC. And when you look at the ratios that Hyperion is putting out there with 400 however many dollars in revenue for every dollar spent on HPC, they're essentially saying that about 16% of the output, the total economic output of the world, rests somewhere on HPC. That still sounds high to me. I haven't done that study. Hyperion does. Okay, fine. 16% of the total output of the world rests on HPC. That's not an ROI study. And if you were trying to do that study, then sending people around the world to survey people in person is a dumb way to do the study because it's really ineffective and expensive, but okay. That's what Hyperion is measuring. If we want to get at actual ROI, you'd have to look at what's the real net profit relative to the investment, and with total investment including all costs. Furthermore, you'd want to look, and because it's complicated, that's normally done at a business unit level, not what's the ROI of buying an individual thing like a stapler, right? What's my ROI of buying a stapler? Well, I like stapling things. It's difficult to get the ROI of an individual tool. So it's not usually done at that level. What companies usually look at is a hurdle rate. If I buy this, does it clear my hurdle rate of 12%, 15%, which is related to my cost of capital? Presumably, companies that continue to invest in HPC do so because it clears their hurdle rate. If you want to look at the ROI in that sense, presumably the ROI is somewhere in the range of 20% to 50%. If it were more than that, I would keep buying it until that stopped and it got down closer to the hurdle rate where the marginal return went down. And that's my point about the marginal ROI here. Your return on the first $100,000 is very different from the return on the next $100,000 when you're going from 50 million to 50.1 million. You have to look at marginal returns. Future returns have to have discount rates. Industry level ROI has zero-sum problems and prisoner dilemma problems where my competitor and I are both investing in HPC, each to stay ahead of the other, but then our relative market share from one to the other doesn't change. So what's the relative ROI? That's a prisoner's dilemma kind of problem. It still begets innovation and drives competition going forward, but it just means that ROI is very difficult to measure. It's not that it isn't worthwhile to try to measure, but no one here is actually measuring ROI with a comprehensive ROI study, and it's irresponsible to suggest that there's this dramatic ROI for for investing in HPC. So it got me thinking, well, what can we measure? Now, first of all, in 2014, this is a landmark study we did with the Council on Competitiveness in the United States, the SOLVE report. The URL for it is down there at the bottom. This is something that doesn't change very fast. When you poll companies on how important is HPC? Well, 86% of HPC users, commercial HPC users, agree with the notion that it's critical to the future direction of our business, presumably because that's why they're still buying it. 79% agree with the notion for some of our problems, HPC methods are the only practical solution. Is there value in high performance computing? Unequivocally, absolutely. And we have shown that in survey after survey again and again. Now, if you're going to start measuring ROI, you have to look at, well, what about someone newly using HPC for the first time? What are the returns there? We've done other studies with the council and with the National Center for Manufacturing Sciences, independent studies on the entry level and mid-range of HPC, looking at the dynamics of adopting high performance computing for the first time. It gets fuzzy down in there in terms of what those returns look like and how it takes those to play out. It is not 4,300% ROI right out of the chute. What can we measure? Well, we do have some indicators here. If we were going to have a hypothesis around there's really a big positive ROI here. We have been surveying HPC users since 2007, and in every survey, for demographic reasons, at least, even if it's not a budget survey, even if it's some other kind of technology survey, for demographic reasons, we're asking about the budgets, and it has info in bands. Not everyone always provides those budgets, but for a lot of surveys, we have it. We counted 58 public companies that in the range of 2007 to 2018 have provided budget data in more than 1 year. This is a winnowed down list where you have to get rid of, well, first of all, we trimmed out some Indian companies that are traded on Indian markets that provided dramatic outliers because of inconsistencies in how those markets are counted from year to year. So when you look at historical data, it becomes very difficult to chart, and we had to take those companies out. So we're looking at the non-Indian markets in this case. We also excluded those who provided multi-year data that extended into 2019 and 2020 because we wanted to be able to do some forward-looking analysis. So we looked at only that 12-year range from 2007 to 2018. That's 12 years, not 11, because it's inclusive of both endpoints. All right, and here's the experiment that we could run. Assumption. There's a positive correlation between expected profits and stock price. A company with a public trading company with better expectations of future profits has a positive effect on its stock price. Go ahead and fight me on that. I'm saying that it's correlated. There is a correlation between profits and stock price. Hypothesis. There's a positive correlation between buying HPC and future profits. That would mean that we could look at stock prices to look at, is there a positive correlation between HPC expenditures and profits, which would then show up in the stock price? No, I'm not claiming this is an ROI study. This is a snapshot that would show something if there's something really dramatic going on where HPC has a measurably better ROI than anything else you might buy that clears your hurdle rate. It should show up this way. And here's what it looks like. This is way too complicated a chart, but this is every company that we tracked with this, looking at their relative stock price beginning in 2005 as a beginning point, with budget data starting in 2007, and marking where do we get the first budget data, where do we see increases, where do we see that it's steady, where do we see decreases, is it a temporary increase, is it a temporary decrease? And then the ones that are showing in green or shades of green are the risers. It's a lighter green if it rises than falls. So it's a temporary increase. And then the blue lines are the steady ones. The orange and red are the ones that fall. It's orange if it's a temporary fall. It's red if it's a permanent fall. And then the black dotted line is the Dow Jones Industrial Average. Really difficult to see on this chart. Are the green lines doing better than the red lines, which would be the hypothesis, or better than the blue lines? Let's break them out. Here's just the green lines. How are they doing relative to the Dow Jones Industrial Average? These are people with increases or temporary increases in their HPC budget. Difficult to see much here. Here's people with decreases or temporary decreases in their HPC budgets. Again, difficult to see much here. Here are the ones where the HPC budget stayed stable over all of the reporting that we're looking at. Difficult to see much here. We can do the math. HPC using companies as a group did not outperform the market in general versus the Dow Jones Industrial Average by any kind of statistical amount. When we look at the subgroups, the best subgroup was the one with increasing HPC budgets. If you invested $1,000 basket back in 2005 in the ones that had an increase in HPC budgets over that period, your $1,000 basket would be worth most with those whose HPC investments increased over the forecast period. 1.7% compound annual growth yearly, better than the Dow Jones Industrial Average. That's statistically better. Okay, great. Is that due to the HPC increase? That would mean that there is a correlation between the spending increase and the expected future profits. Turns out no. The stocks in that group outperformed the Dow Jones Industrial Average in the 2 years before the increase in budget, not in the years after. When we look at when did the HPC budget change get reported to us, the years after that track the market. The years before the increase in HPC budget is where it outperforms the market. Forward-looking stock price is not better in this group than it is in the other group. This analysis really suggests that the correlation is that my performance this year is what influences next year's budget. So I've done profitably this year. Next year, I get a bigger budget. Or I've done poorly this year. Next year, I get a smaller budget. I asked you on the call, have any of you ever experienced this in your own companies? The company's not doing well, my budget gets cut. The company's doing really well, my budget goes up. This is a very natural thing that people might have predicted happens. And in fact, you can look at on the previous charts, you can see the dip in the 2009 recession. And then, what are the effects of that? This, again, doesn't go back to saying HPC isn't worth it. It's just the way that budgets work, right? And that we have to assume that the long-term benefits of HPC are supporting ongoing business, but there's nothing here that suggests there's some dramatic magic that HPC increases profitability and therefore you should go buy more of it. This is still not an ROI study. Hyperion study is not an ROI study. We did this for two reasons. One, it's irresponsible to suggest that there's some positive ROI, let alone a dramatic increase in ROI from increasing HPC investments. That study from the Department of Energy and NSA and Hyperion, where they directly say that that's political. They're trying to say, hey, go buy HPC. They're being cheerleaders. It's irresponsible and they should stop. That study's embarrassing and it has a poor conclusion. It just shouldn't be out there. This isn't a study either. And neither is Hyperion's, not really for ROI. The second reason that we've done this is because of what it does have a lot to do with is our analysis of what happens to budgets in a recession. Because that's what we're looking at with COVID-19. So this is also a worthwhile exercise when we're trying to forecast what this market's going to look like in 2021, in 2022, when we have a disruption to the economy. The same thing if there were some sudden spike or boom year that was really going on in the economy, that would help us predict what's going on in the market. So it's not merely to be a sniper here, but also to inform our own research that we can go look at this model. So now let's check in on our forecast, our 5-year forecast, 2020 to 2024. Reminder again, 2020, the current year, is still a forecast year. We do have early indicators here, but it's still a forecast. We're not calling what's gone on yet in 2020. There's more to be counted, in case that's a familiar refrain to any Americans on the call right now. HPC market forecast out to 2024. This is how we've been looking at it. This is a chart we showed previously, but just as a touch base, worldwide high performance computing market is going to grow $55 billion to 2024. That's a 7.1 compound annual growth rate from 2019. Cloud continues to be the major growth segment. Government sector is going to be the highest CAGR. Continuing to concentrate into larger configurations, partly fueled by exascale, which is very exciting. And I don't have a lot of discussion about exascale in this presentation today. It's still coming. I think it's been well covered. It's going to be a major story next year. And I think there's a lot of excitement out there, but there's not much beyond that we have to say as analysts. The lower end systems have a higher replacement by cloud computing, which we already discussed. The big thing to check in on is the global COVID-19 pandemic, which is having a dramatic effect on the HPC market revenue in the near-term years. By 2024, we get back onto the line. Now, this is what we've been saying in this space. This is a quote that my partner, Chris Willard, and our co-founder has said to me for a long time, and I always love when he said it: when you make a forecast, it has to be bound by what's realistic. Reality has no such restriction, which is why forecasts are smooth in general, and then reality gets bumpy. In this case, we had terrific indicators, not terrific, I mean specific indicators about how the market was going to be bumpy. And that looks like this. This is in general, no years on this. In general, what happens in a recession. We described this in our previous webinar, but I'm going to touch base on it here again. Year 0 pre-recession, and then a 5-year forecast with a steady growth rate. Then a recession happens in year 1. This is in general what that looks like. A dip in year 1 is predominantly due to deferral of purchases. My budget is constrained, and a lot of purchases slip from year 1 into year 2. That gives you a boom year in year 2 when the recession passes, and then you recapture a lot of sales from year 1 as the market comes back in. Years 3 and 4 have an echo effect of this due to purchase buying cycles primarily, where you get a diminished echo effect and you can't even get a dip. You have an artificially high growth rate from year 1 to year 2, which people start saying, hey, the market is growing at 30, 40%. Well, really what happened is you deferred a lot of sales from year 1 out to year 2. Now, there is some lost revenue. The troughs in year 1 and 3 are deeper than the peaks in year 2 and 4 are high. So there is some lost revenue, but primarily what you look at is a deferral. And we've seen this before. This is what the market looked like in the year of the recession in 2009, followed by those years in the 5-year forecast after 2008. It's not exactly the same as what we showed, but as I said, reality is different from expectation. So you see the forecast of the smooth line from 2008, and then what actually happened from 2009 into 2010 and beyond. So we have seen this pattern, and that's what we forecast to happen. We modeled the multi-year effect by vertical market using a baseline from pre-pandemic budget expectations, which we continue to monitor, of stable ongoing economic conditions and the really stable underlying demand for high performance computing that hasn't gone anywhere, but then you have an artificial recession on top of it. And then what happens is we expect the market to fall 10% below what we had forecast for this year, which translates to a 3.7% decline year over year, which should be the first year of market decline since that 2009 recession. Most of that is delayed, not lost. Because of that effect of the troughs are deeper than the peaks are high, there is a total of $1.2 billion in revenue loss over the course of the 5-year forecast that shows up there before you get back on the line in 2024. Now, we highlighted all along as we've given this guidance over the course of the year that this has significant forecast risk, mostly due to how long does COVID-19 last as an economic damper. Let's check in on that just qualitatively. We are not editing the forecast at this time, but just qualitatively. This is how this shakes out for vertical markets, and we reported this earlier this year. You see the dip in 2020, followed by the spike in 2021. The hardest hit vertical markets, this was modeled individually by vertical market, because we saw a big effect in areas like energy, where we already had a low price of oil even prior to the pandemic. Now this is extending the reduction in demand for oil for a longer period of time. Retail is having a big effect. Large product manufacturing, which is automotive, aerospace, big effect. But much less effect, or even going slightly the other direction, in biosciences. National research labs, national agencies, national security, also very stable. How does that look over the forecast period, and how realistic is that going into 2021? This model is predicated on the notion that the economic effects of the pandemic really don't last beyond early 2021. And therefore, you start to recapture lost sales beyond that. Now we can start doing a sanity check on that. How realistic do we think that is? I would say at this point, there's significant concern for me as an analyst that the demand side depression for some of those segments, particularly manufacturing and energy, could last beyond early 2021. If that happens, we will have to extend the effect of the pandemic for those vertical markets. You will see an edit of this forecast that takes that into consideration. And also, when you start to get it going on for longer than 1 year, this is really a 1-year model, but if it goes on for longer than 1 year, it starts to increase how much revenue is lost and not delayed. You get more organizations that simply drop a purchase cycle and it doesn't come back, or reduce a purchase cycle and that doesn't come back until the next purchase cycle when it would have come back. So there's revenue, more revenue would be lost in the market. We are not changing the forecast at this point. The next time we'll do that will be in early 2021, when we're updating where we actually hit with 2020. But it's starting to look like some of these segments, this is sort of an early warning that we're going to have to look at whether some of these segments, the economic effect of the pandemic, last longer than we had previously modeled. Now, product and services, we can also do a check-in on. Cloud computing was the big thing that goes up when other things are constrained, not to the same extent, but we've been saying that if you constrain the on-premise purchases of servers and storage, then cloud gets a big bump. So we're projecting for 2020 big growth in cloud above and beyond the growth that we would have already seen. And then in regions, the other thing that we were saying is when we first gave this original guidance back in March, the assumption then was that Asia Pacific would be the hardest hit, followed by EMEA, followed by North America, US and Canada. By the time we actually published the forecast, it had reversed, and we were looking at a bigger effect in US and Canada, and then EMEA in the middle, and less in Asia Pacific. That might continue, and we're going to have to monitor how these regions look as we get into the actuals for adjusting our forecast next year. So how's this forecast looking? Early indicators are that 2020 is trending according to how we forecast. I'm not going to say yet that those are the actuals, still counting votes as it were, but we're expecting dip in on-premise deployments due to the economic effects of the pandemic and some of the early quarterlies from some of the major vendors. I think that's looking on target. Meanwhile, the cloud sector does appear to be booming. That also appears to be on target. So I don't see any evidence at this point that our forecast is way off. I think that we did a pretty good job back early in the year saying this is coming and we're going to have a dramatic change to our forecast. Here's what it looks like. We were the analysts who put out a change in the forecast. And as far as 2020 is concerned, at least the trends seem to be hewing toward that forecast. And then we'll see how the actuals do after we get to the end of the year and we actually count them up. What about 2021? This forecast has been assuming normal economic activity resumes. Now I think that's going to be in doubt, and we're going to have to look at whether we start making edits to this forecast for 2021 and 2022, dependent on the length of the economic effects of COVID-19 as an economic damper. And the longer it lasts, the more we will find spending that is not only delayed but canceled. So that is how we are continuing to update this forecast. SC20 trends. First, effective AI on HPC. This is data from this year's budget map. In terms of what the effect on the HPC budget is of those who are doing machine learning. And what we're seeing is organizations that are doing machine learning as part of an HPC budget are seeing significant increase to the HPC budget as a direct result of machine learning. And that goes above and beyond the normal growth rate for the market when we start modeling that in. And we've taken that into consideration in our long-range forecast. This chart isn't really edited for the effect of COVID-19, but more has to do with the ongoing effect of AI in HPC. I will quickly say that we did not see this same effect with big data. When big data was really the thing, and you have to get in your Wayback Machine and go all the way back to 2013 and think about what the supercomputing trade show looked like in 2013, 2014. It was a big data show, and everyone was all up on big data. We were the ones saying big data, yes, data science is real, analytics is real, but it's not having an effect on HPC budgets, and it's not having an effect on the enterprise budget as a whole. And that was true. And companies that followed the opposite guidance from other analysts were investing in big data appliances, big data business units, almost all of which failed. That wasn't the way to go. You have to really monitor the effect on HPC budgets or budgets at the top line to look for where there's spending opportunities. Here we are seeing it with the machine learning adjacency to HPC. And this implies not only a spending opportunity, but for the cases for mixed workloads, in particular, in this case, GPU heavy configurations, which can serve both masters of HPC and machine learning well. And that is a relevant trend as we head into SC20. It's also a relevant trend as we talk about processor consolidation. CPU and accelerator consolidation is going to be a major trend for next year, and we're going to be talking about it at SC20, both in terms of the literal consolidation, NVIDIA acquiring ARM, AMD acquiring Xilinx, Marvell acquiring Inphi, but canceling ThunderX3, which consolidates more of the ARM into other areas that are not Marvell. Technology consolidation, I think, is even more important. That what we're going to see is we're going to start seeing all Intel environments with Xeon CPUs and Xe GPUs on an Intel fabric or an Intel chip consolidated. AMD EPYC CPUs and Instinct GPUs consolidated in an all AMD environment. NVIDIA ARM CPUs and A100 or future NVIDIA GPUs in a consolidated NVIDIA package. That is the trend for 2021 and beyond. And to look at what this looks like, we're going to release a little more of our data here that we previously talked to our clients about from our end user rating survey. in the processor module specifically. So this is a broad-based end user survey that we did in the first half of this year, and we've released full results to our clients to look at end user ratings of vendors and their impression and satisfaction across the different segments. And overall, we can look at loyalty, we can look at satisfaction, we can look at projections for market share shifts. And we did this in 4 modules: processors, servers, storage, and cloud. To give you a sense of how quickly things shift, you'll notice that we had Marvell Thunder X in the CPU module. We wouldn't have included that today. That's a little different than it would have been before. But we're trying to get a sense of how these different vendors get evaluated by end users. There were really only 7 survey questions in this module, looking at awareness, looking at experience of use, evaluation overall from a technical perspective, that's capabilities, performance, operational capabilities like ease of use, service manageability, future outlook for HPC, likeliness to use in the next 2 years and whether that's growing or shrinking. And then combinations of these things give us ways to look at notions of, say, loyalty or market share shift in this notion. Ratings explanations, I'll just do that as I go. Study demographics, we had 194 end user respondents from 30 countries worldwide. I need to emphasize that we do a thorough job of cleaning this data. We had over 300 raw respondents come in that cleared all of the hurdles that you would tend to look at the top level. And then when we really dug into them, we found a lot that are suspect because people try to complete surveys to get their rewards. We want to give our clients the best data we can. We would rather deliver 200 really good respondents than 300, but a third of them are fishy. So we do a good job cleaning this data. 194 respondents, range of budgets, range of sizes from 30 countries around the world. And we're going to show some highlights from that processors module. We have data across 4 different modules here, but within processors, all right, some of the things that you would expect. On the awareness side, Intel CPUs, people are aware of them. NVIDIA GPUs, people are aware of them. But AMD has really been coming up. What you see is that awareness there. We're measuring how aware are you on a scale of 1 to 5. When you see that column that's average, that takes the 5-point scale, and what's the average if expert intimately aware is a 5, and the bottom no awareness is a 1. Notice there's no 0, so the midpoint is 3, not 2.5, which means that if you get down to, say, the Fujitsu and the Marvell, you have really below average awareness, where you have more that are on the vaguely or none side than on the positive side or informed and expert. So that average is the average score. Percent 4 or 5 is what it sounds like. It's what percent of the scores would fall into the 4 or 5 range. And with Intel, with Xeon, you get 95+% of people saying they have that kind of awareness. All right, not a big surprise here. Experience use, that's where, current usage of Intel Xeon is running 98%. This is where you get a huge market share. But NVIDIA also running 90+% of people who say they have it somewhere. That doesn't mean market share, but some level of current experience with the processors. Intel and NVIDIA really coming up, and then you see everyone else with less experience, but still AMD improving from where it's been in the market before. Technical impression is where AMD really starts to come up, and when you do that weighted by awareness, right? If you give people who have more awareness higher weight on their scores than people who have less awareness, all of the scores always come up, but AMD comes up by enough that when it's weighted by awareness, people give EPYC CPUs a higher technical rating than they give Intel Xeon CPUs, and NVIDIA is the highest of all. Future prospects for HPC. This is now forward looking. What do you think will happen? What What do end users think will happen with these processors in HPC? Again, now AMD overtakes Intel, and people love the NVIDIA GPUs, but then everything else that's down market does a lot worse. And this gets really interesting. The AMD GPUs, the ARM CPUs, the Intel GPUs, or FPGAs are all further down in terms of the future outlook. If we look at likeliness to use in 2 years, again, that's what's on top of the market. Intel CPUs, NVIDIA GPUs, EPYC CPUs, then there's a big drop down. If we compare present to future, well, that's where AMD GPUs do make a jump. That they have the biggest potential to get a drag along together with the CPUs, and other things are trending in the other direction. But still, what we see is a big thing on top is the Intel Xeon, the AMD EPYC, and the NVIDIA GPUs, just in different orders. If we look at what are the likely adoption by non-current users, that's where AMD does well, because they're coming from behind in both cases. There just aren't enough non-Intel Xeon users or non-NVIDIA GPU users to make the adoption by non-users even a meaningful comparison. That said, AMD is the big forecasted market share gainer. And what that means, selected conclusions from the processor side. I haven't even shown all of our charts, and I'm not getting into the other modules right now for servers or storage or cloud, although there's a lot of interesting data in those right now. What the market is saying they want is Intel CPUs or AMD CPUs together with NVIDIA GPUs. But that's not the way the market is going. AMD has its own GPU. Intel has its own GPU coming. Those are lower rated than the CPUs. NVIDIA now has its own ARM CPUs coming, but those are lower rated. And when it gets forced eventually into single packages, not that that's coming immediately, but the market's going to drag behind that. And that's going to be a big challenge for end users if they start feeling forced onto one or the other. To the extent that that happens, the big potential for market share gain right now is on the AMD side. We don't forecast the success or failure of individual companies or technologies as analysts because we don't like to influence it. But I'm saying this is the data conclusion from the user rating study, is that the market share gain is forecast to come on the AMD side. Other quick highlight from across this study, and I'm almost done with the presentation side. If you have questions, you can get them into the chat function on this webinar. I'll be getting to those shortly. Number one user ratings by category. You can see we've got the 4 modules, 10 different ways we can cut the data to look at different aspects of this. You really see, depending on what we're measuring, it's Xeon on top, it's EPYC on top, it's NVIDIA on top. Those are the things that users like the most. Servers kind of splitting between Dell, Cray, and HPE. Inspur showing great loyalty scores. And there were some interesting things coming out of China that if you try to restrict the data down to China, things get a lot more interesting there. For example, what's the effect of, say, AliCloud, which shows up well in China, but not where the Alibaba Cloud in China, but not anywhere else. Atos also essentially lost the loyalty to Inspur in a tiebreaker. Great loyalty, great projected market share gains. Storage really well spread out, but DDN and Dell EMC did very well. Cumulo showed great in terms of loyalty. They just don't have as much presence as everybody else. Weka does really well in terms of planned adoption among non-current users. Cloud, AWS almost swept the categories. Projected market share gain was best for Azure. But the real thing I would say in cloud is that there was a clear top 3 on really every question, which was AWS, Azure, and GCP. Google Cloud were very closely grouped at the top on every question. And then there was a big drop down to who was number 4. And then there's a big drop down from who was number 4 to everything else. So definitely interesting things coming out of these user ratings. Maybe sometime next year, we'll give a more full public presentation on all of it. Right now, the full study is sitting with our clients who are getting to digest all of that. Last thing I'll mention, because I promised I would, SC20 trends. I have to talk about storage at some point. And I think the important thing that's been going on is, according to what we forecast back at SC17, SC18, we've been talking about this was coming in terms of more implementations of flash, more implementations of SSDs. Now it's showing up as NVMe and persistent memory, and the emphasis on tiering. We are editing how we look at this in our upcoming technology survey. We're deviating from previous site census formats in order to take this tiering into consideration, looking at all of the different ways this storage can be implemented and trying to get a sense of how that's implemented today. And we get a lot of discussion around, well, sure, performance, it should just be all flash. Like, right, I get it, but that's also more expensive today, and it's not what people have implemented today. And we have a panel as part of SC20 in track 8. It is panel number 116, or PAN 116 if you want to do a search for it on SC20's website. The diverse approaches to tiering HPC storage. I'm the moderator of that panel with a long list of panelists from a lot of different storage companies talking about their approaches to tiering specifically in this space, including the notion of cloud as a tier and looking at object and archive and not just the flash and the NVMe components. So I think this is a hot area, and we're going to continue to see it or discuss it. You can find this as part of SC20. So that's where we'll be next. SC20 is starting next week with the tutorials and workshops. We're going to a virtual SC20. That means it's going to be going on for a longer period of time. It's the week after next, November 16th through 19th. It's more of the traditional conference and program. We'll be participating in that as well. Right after that, I'll be participating in the CHPC National Conference in South Africa. I'm sorry that I don't get to go there this time around. We're still in the realm of virtual conferences, but that makes it easier for me to rebound. And then I'm giving one of the two keynotes for the Society of HPC Professionals. I'm thrilled to be keynoting along Bob Metcalf, quite a notable in our space. He's the other keynote. So check out that Society of HPC Professionals event. We're going to be busy for the rest of the year with some of these virtual events. Working with Intersect360 Research. If you want to know more, so do sign up for our newsletters, answer our surveys, stay on top of our research. Listen to our podcast, This Week in HPC. You can find it on iTunes, on SoundCloud, on our own website. And of course, if you'd like to become a client, you can go to our website, find our complete list of services. Reach out to sales@intersect360.com. I just saw a typo in that. Don't click a hyperlink that spells it intersect, but do go to sales@intersect360.com or just email me directly. And we'd always love to work with you. And I'll conclude there. I'm almost on time, and I do have time to get into question and answer. Thank you very much for being here. Okay, I'm going to stop my screen share to go to full screen, and I've got some of the questions here. There's a long question around the definition of HPC, but gets down to the bottom of it. What do you define as HPC in industry, and what is your experience of the distribution of shades in terms of embarrassingly parallel up to real supercomputing codes of high performance computing in industry? Okay, so with high performance computing, first of all, we tend to be looking at workload more than we're looking at any particular configuration. And if you get into science and engineering workloads, then that's easy. You're doing science, you're doing engineering. Then there's a lot of finance and economics and other business use cases that hew to that are also quite easy to include. Beyond that, if you get into something like data analytics or data science, those are business use cases. And I won't say we're counting all of data analytics in this space, because a lot of that really doesn't trigger what we would look at for HPC. For HPC, first of all, we are looking for multi-node parallelization. If it fits on one node, it's a workstation, and it's not HPC in that context. If you get into things that don't really parallelize at all, then you're not going to be doing HPC. We're looking for multiple nodes, and we're looking for, it has some notion of performance that requires performance as a consideration in terms of computing, like the CPU, in terms of the interconnect, in terms of the memory, in terms of the I/O, and that helps guide what's HPC. And we have full definitions of what constitutes HPC on our website and also in every survey that goes out. How much of it is embarrassingly parallel? Relatively little. There are not very many true embarrassingly parallel applications in high performance computing. Some of them that have been embarrassingly parallel drift out of high performance computing. And I'll get to that in just a second. This is an interesting question. Large scale Monte Carlo simulations, which we see a lot of in, for example, risk management and finance, we see them in genomics. Those are pretty parallel. And are enduring in HPC because they continue to get more complicated. You keep adding fidelity into models and more simulations, and you need more calculation and low latency, so those stay in there. But here's a problem with embarrassingly parallel applications is it becomes easier to degrade them even further to where they run not on servers, but on grids of workstations, PCs, phones. Look at something like SETI at home, where you can download targets to your mobile device and contribute to the overall solution. We don't track that as HPC because it doesn't really need a network of servers that implies some sort of high performance network. Now, SETI at home is an easy example, but let me talk about two that used to be HPC that we don't think are anymore. Finding a new large prime number when I was early in this industry was being solved on some of the biggest craze. And now it's exactly a SETI at home kind of problem where you download targets to your local device and you contribute to the project. If you want to find the new largest Mersenne prime number of 2 to the n minus 1, then that's a different kind of application. The larger thing that has gone that way is rendering in the entertainment space. Rendering used to be an HPC application. Now it's not anymore. It used to be something that needed high performance servers. Now it's done on grids of PCs. It is not a high performance application. It has drifted out of the bottom of the market. If you want a really exciting thought process, think about this in the long run, like decades out, with regard to machine learning. Something Chris Willard always liked to talk about is, does the application continue to get more complicated as fast as computers get more powerful? Which means in 20 years, is machine learning training still going to be the advent of going to be an aspect of HPC? Or is it going to drift out of the bottom of the market as being parallelized to things that are smaller than HPC? HPC will still exist, but not all applications hold on to it. Okay, how do we present HPC value as an investment for a not-for-profit HPC university or government lab? The misuse of the term ROI is trying to recapture the impact from that investment. Do you have a recommendation on how this can be done that would help justify the large investments using a financial argument? That's an outstanding question, and that misnomer of an ROI study that I was talking about before with Hyperion Research also gets into that with something they were calling return on research, which they never rigorously defined. So I think that's part of the irresponsibility of that study to say that that's where that is. I don't know what to tell you other than, yes, it's a significant problem, but that's as it has always been in terms of chasing the value of science in general. What is the value of scientific endeavor? NASA deals with this in terms of space exploration. What's the value of it? Well, I don't know. It's kind of fuzzy and out there in the future, but do we believe in science? And I think that's where that really comes down to eventually is the fundamental question of, is there a fundamental value in scientific exploration? If there is, then from there, it's not a very long walk to say that high performance computing is now a very significant way that that's done, because a lot of what we're measuring or simulating is now exceeding our ability to do that in the physical world. And AI helps with this, because AI helps steer exploration in areas that are difficult even to simulate physically because we don't have enough of the data. I'll give one of my favorite examples with that, because it starts in the scope of what we've already seen and then extrapolates. 20 years ago, in the year 2000, was the first mapping of the human genome. And that relied heavily on supercomputing to help get that done. That was in DOE labs that they did a lot of the work on mapping of the genome. That was a supercomputing thing for the world's most powerful supercomputers. Now look at where we are 20 years later. That didn't end genomics, that started genomics, right? That you did that. You look at what's happened with computational genomics over the last 20 years and where that is in a field of study and what it's empowered. So if you get people believing in that, I think we're maybe 10 years away or less from getting our first comprehensive map of a human brain. We can already model a few milliseconds of a rodent brain. How long is it from there generationally to where you can model a human brain? And that will kick off a new generation of brain research in much the same way, in a way that you can't do physical studies. And if you believe in the science there, then that's the value that goes forward in those ways. So is there a financial way to do it? Not that I've seen. If so, it would be quite popular with universities worldwide. I think you have to sell the value of science within the notion of here's science. Then, yeah, start pointing to what are the areas of science that are empowered. And I think you can use access to supercomputing resources as a tool for drawing researchers and faculty to your organization. I'll stop there on that question. For the processor GPU awareness slide, is that for consumer hardware, HPC hardware, or both? That's an easy one. That was for HPC hardware. That's polling HPC users about HPC hardware. I'm sorry I didn't make that distinction on that slide. What are your feelings about NVIDIA competing more directly in the CPU-based HPC computing space utilizing ARM versus ARM being used in more limited roles such as SmartNICs, Ampere GPUs-oriented solutions, NVIDIA? I think that is a smart strategy for NVIDIA. In fact, we said 2 years ago that was how that was going to line up for NVIDIA as their open power started deteriorating and power processors started deteriorating in this market. Then ARM became the next best option for NVIDIA in the medium term or long term from then, medium term from now. If NVIDIA can't trust that they are a preferred solution for Intel Xeon CPU-based systems or AMD EPYC-based systems, then they need another option for the host processor, and that almost has to be ARM. And NVIDIA investing in ARM makes a lot of sense, which doesn't mean it's what the end users are hoping will happen, but I do think strategically it's the best move for NVIDIA, and I think this prediction, we will start seeing more complete NVIDIA-based solutions and even integrated ARM plus NVIDIA packaging for HPC, maybe not in 2021, but certainly in the relatively near-term roadmap. I think that makes a lot of sense for NVIDIA in terms of competing in this space. The wild card here is what happens in the hyperscale market. And it's a wild card for this reason. If any hyperscale player that does a lot of AI, whether it's a cloud provider like AWS or Azure or Google, or a non-cloud hyperscale company like, say, Facebook, right, is a reasonable example here. Apple, if it does a lot of AI. If any of those tier one hyperscale companies that spends billions of dollars per year individually on hardware wants Intel or AMD, wants x86 plus NVIDIA GPUs, those companies are large enough to be market makers in of themselves that could keep those configurations alive over PCIe. Have I heard anything about HBM2 as it applies to HPC? Yes, I've heard a lot about HBM2 as it applies to HPC, and it's part of a lot of people's roadmaps and configurations, and it's part of what we look at in terms of surveying that and whether we want to do more memory-specific surveys in this space. I can say that memory bandwidth continues to go up in importance, and that's because memory per core continues to be extremely important in this space as it pertains to HPC, and that has not gone away. We do continue to look at that in HPC. FPGAs are known to solve unique problems at highest performance that CPUs and GPUs cannot do. Why isn't there much more traction in HPC to use FPGAs in the future? Do I think it's because of ease of use is still a problem? Yes, ease of use is still a problem. Programming FPGAs is still a problem. FPGAs have been around a long time in this space. However, I've also noted the GPUs have not really threatened FPGAs so far in this space because of something that we predicted going back 10 years ago. Look at, I should have brought up slides from 10 years ago on this, and I still can. Looking at how GPUs are adopted, which we were forecasting then. GPUs started by coming from the entry level and mid-range. They grew up out of the PC and workstation space into this space, starting from entry level and workstation and working their way up, and primarily still for codes that are floating point heavy. I'm talking about in terms of HPC more than machine learning at this point, machine learning training at this point, things that are really floating point heavy. FPGAs, which have been around in this space for a long time, where we've seen them get deployed, have been predominantly at the very high end of supercomputing and predominantly for applications that are text or integer based. So we see them in, for example, in genomics. Go back to companies like Starbridge had FPGAs in this space, and they would show their Smith-Waterman benchmark all the time. They didn't take off because not a lot of people wanted to learn Viva, which was the custom language that went along with those FPGAs. But still, we see them in genomics. We'd see them a lot in finance, which isn't, it's fixed point arithmetic, which is different from floating point arithmetic. Fixed point is really essentially integer by a different name. So we see it in finance for that. We see it in search, which is at least HPC adjacent on the hyperscale side. And we still see FPGAs in all of these areas. Within the scope of machine learning, FPGAs are really finding a lot of traction in inference in particular. And that, again, is not specifically threatened by GPUs a lot. So FPGAs are still healthy in this space, but they also haven't really grown a lot in this space. And a lot more of the existing movement of share and configurations has been in GPUs, both for the acceleration of traditional scientific HPC applications and particularly for machine learning training at scale. We're seeing a lot of it there. Is the aggregate spend of HPC affected by continued commoditization of HPC components? And do we see any trends that could indicate this possibly at a macro level? Is the aggregate spend of HPC affected? Not as much as you would think. Continued commoditization, the argument there is that HPC gets friendlier and easier to adopt for more people, and then it greases the skids for more types of commercial organizations to do HPC than ever could before. And that is true. And it's why we have a good solid growth rate, COVID-19 notwithstanding, a fundamental underlying strong growth rate for high performance computing in this space. A big part of that is more companies continuing to adopt HPC over time. And the thing is, it's been like that for essentially my whole time in this industry. We've seen increased commercial adoption in HPC. So yes, commoditization is part of that, but it's also not new. That's been the story ever since RISC and Unix were taking over from vector processors, the move from vector to scalar, the move from SMP to clusters, the move from Unix to Linux, the move from RISC to x86. All of these have been increases in commoditization. That's been a general dynamic in this space for more than 20 years. So yes, it's there, and yes, it affects the growth rate. It just doesn't affect it remarkably differently than it's already been affecting it, so you don't see a sudden spike. Any comment on HPC fabrics? Yes. you know, the big things that are happening in HPC fabrics, I would say the big trend is that for exascale, at the very high end, things have lined up around custom fabrics. So Cray Slingshot, um, Fujitsu, and Tofu. We've got our eyes on Atos and BXI and whether that will break through on exascale there, the bulk stream interconnect. Atos has been talking about it. We haven't really measured a lot of it yet. There's still a potential on that one. Dell is maybe noteworthy as the supercomputing company that doesn't have its own custom interconnect. And yes, Dell is a supercomputing company. Just because they don't have any of the large-scale national labs, I would point out that Dell is the vendor behind the largest academic supercomputer in the world with TAC and the largest commercial supercomputer in the world with Eni, the oil company in Europe. Both of those are top 10 on the top 500. Dell is absolutely a company in the top tier of supercomputing. They're just not in the national labs. And that might be because they haven't played in this high-end interconnect space. The rest of it is still InfiniBand versus Ethernet and the different dynamics at play there. I am aware that OmniPath has a potential resurgence with this Cornelis Networks that's spinning out of Intel. I want to reserve a lot of judgment until I see where that goes, but it seems like a major potential opportunity there would be whether or not they get some sort of significant partnership, at least with Dell, if not with another company like Lenovo that also doesn't have its own high-end interconnect. Without that, it's going to be questionable to see how that competes with InfiniBand and Ethernet, because we didn't see a big uptake of OmniPath the first time around. Now, I've got to dig more into that. I haven't had a proper briefing from them yet. I have that scheduled now. It's very new. So that's an interesting description. I saw a question just pop up on my screen without having to look over on this, so I am going to take that on the fly. Where's RISC-V? RISC-V we didn't poll for in our existing user rating study because it's more of a future, and we didn't think anyone would have a lot of current awareness or experience of it. So where it is right now is predominantly in Europe, coming out of the European Processor Initiative, and it does have a lot of potential for uptake there, and it's certainly something we're going to monitor. So I didn't mean to be shunting a lot of that out of our user rating study, but where you had to cut the line somewhere, and we were using current awareness, or our assumption of current awareness and current experience and current market shares is a big cutoff. So we didn't get into RISC-V. We didn't get into other noteworthy things like, for example, the large wafer scale chip from Cerberus. A lot of people have talked about that, just not a lot of current experience around it. And we didn't think a user rating study would give us very good data. That doesn't mean we're not watching those things, or that they don't have the potential for growth in the near term. Someone made the observation, with the exception of network technologies, Intel has had an ongoing issue with attach rate on not CPUs. I think that's certainly true. I don't have a lot else to say there, but that's where that is in the market right now. And with 1 minute to spare, we have cleared all of the questions in the Q&A. I'm delighted that everyone joined for this pre-SC20 market update, and that we were able to get into some of the data that we've been presenting to clients over the course of the year. Still not all of it yet, but to set the tone of some of this discussion. As always, I'm very excited for SC20. I'm interested in seeing how it will play off as a virtual event this year. I'm very sorry that I won't get to see any of you from this call in person, and I'm really hoping we get back to in-person conferences and events soon. A question just came in about, will this presentation be available? Yes, if you registered, you will have access to the recording for this. And of course, if you have any follow-up questions, you can email me, Addison@intersect360.com. Thank you very much for joining this presentation today. We'll end here. Thank you.